Hey everyone, it is great to be back with you all today. We are diving deep into something that has shaped my financial life more than anything else. My biggest investment screw-ups and what they taught me about genuinely building wealth. I am not here to pretend I am some guru, far from it. I have been through the ringer, lost a lot of my hard-earned money. And frankly, I have made pretty much every mistake in the book when it comes to investing, but those painful lessons, those financial black eyes, they are what led me to where I am today, committed to sharing these experiences so you hopefully do not have to go through the same thing. My journey started, like many of yours might have, young, eager, and totally clueless about how money really worked. I saw headlines, heard whispers about quick riches, and honestly, the idea of getting rich fast was incredibly tempting. My family background was pretty ordinary, so the desire to change my financial situation quickly was strong. I did not have a solid financial education, just a burning desire to make money, and that, as I learned the hard way, is a dangerous combination. I was in my early 20s, full of confidence and with a small pot of savings that I had worked incredibly hard for. I thought I was ready to conquer the market, but really I was just a lamb to the slaughter. I chased every hot stock, every trending cryptocurrency, every piece of gossip I overheard. If someone on an online forum said it was going up, I was in. If a friend mentioned a sure thing, I was ready to throw my money at it. I bought high, sold low, and watched my savings evaporate faster than I could earn them. The emotional roller coaster was exhausting. Every gain felt like genius. Every loss felt like a punch to the gut. I was addicted to the thrill, to the possibility of that big win, and completely blind to the risks I was taking. One of my earliest and most painful lessons came from short-term speculation. I thought I could outsmart the market, predicting daily fluctuations. I spent hours staring at charts, convinced I could see patterns that no one else could. I made a few small wins early on, which only fueled my overconfidence. I thought, this is easy. Why is everyone doing this? Then came the inevitable crash. I remember one particular stock. It was being heavily promoted everywhere, and I bought in big, using almost all my available capital. The price soared for a day. I was ecstatic, already mentally spending my profits. The next day, it plummeted, and I held on, convinced it would rebound. It did not. I watched as my investment lost 50%, then 70%, eventually becoming almost worthless. It was a brutal wake-up call, a stark reminder that the market does not care about your hopes or your predictions. Then there was the time I fell for a complete scam. It was an investment opportunity that promised incredibly high, guaranteed returns, something like 15% a month. Red flags were everywhere, but I ignored them. The initial investment was small, and they even paid out a small return a few times, building my trust. Then they encouraged me to put in more, much more. And I did. I even convinced a few friends to join in. Of course, the money vanished, along with the people running the scheme. The shame and guilt of not only losing my own money, but also potentially impacting my friends was immense. That experience taught me a profound lesson about due diligence, skepticism, and the eternal truth that if something sounds too good to be true, it almost certainly is. Another major mistake was not understanding risk management. I would go all in on a single investment, convinced it was a winner. This is what they call heavy position. When I did that, any small dip in the market meant huge losses for me. I had no diversification, no safety net. It was all or nothing, and most of the time, it was nothing. I remember putting a significant portion of my remaining savings into one company's stock, believing it was undervalued. The company then announced some bad news, and the stock tanked. I was wiped out again simply because I had failed to spread my risk. It was like putting all your eggs in one fragile basket and then dropping it. My emotions were my worst enemy. I would panic sell during market downturns, locking in losses, only to watch the market recover a few weeks later. I would get greedy during bull runs, buying at the peak just before a correction. It was a vicious cycle of fear and greed, always leading to me making the wrong decision at the worst possible time. I could not separate my feelings from my financial decisions, and that proved to be incredibly costly after accumulating a significant amount of losses, essentially wiping out years of hard-earned savings. I hit rock bottom. That is when the real learning began. I realized that my approach was fundamentally flawed. I was chasing fantasies, not building a future. I threw away the get-rich-quick mentality and started from scratch, educating myself on proper financial principles. I devoured books, articles, and reputable financial advice. I learned about compound interest, diversification, asset allocation, and long-term investing. It was not exciting, it was not flashy, but it was real. Now, I am in a much different place. I do not do aggressive investments anymore. My focus is on stable savings, low risk options, and a rational view of money management. I am certainly not a millionaire, but I am building a solid foundation slowly and steadily. My mission now is to share these tough lessons, to be the person I wish I had listened to back then. I want to help you avoid the financial landmines I stepped on. So let us talk about the first crucial concept that radically shifted my perspective, and it is something you absolutely need to grasp. It is the idea of inputs and outputs. This might sound really basic, almost like a physics lesson, but stick with me. Remember the first law of thermodynamics, the law of conservation of energy? Energy cannot be created or destroyed. It can only be transferred or transformed. It does not just appear out of thin air. The same principle applies to value and money. You cannot create value from nothing. If you want to understand how wealth is actually created, you need to see everything in the financial system as units of value. And these units of value, they are transferred or transformed. They are not just conjured up. Think about it this way. When you work, you are providing your time, your skills, your knowledge. That is an input. You are creating value with your brain or your hands. In return, you receive money, which is a representation of that value, an output. It is a transfer of value. Even when someone starts a business, they are not creating value from nothing. They are taking their ideas, their effort, their time, and transforming them into products or services that others find valuable. That is the transfer. Real estate has value because people need places to live or work. Businesses have value because they provide goods or services that people want or need. And you as an individual have economic value. You have a certain amount of value you can provide per HR, per week, whatever. This is your input and the result is your output. Understanding this input-output dynamic is fundamental to breaking down how business and investing truly work. Now, I know some of you might be thinking about central banks like, hey, what about them? They can just print money. Are they not creating value? This is a common misconception, and it is a really important one to clarify. When a central bank prints more money, they are not creating more value in the economy. They are simply watering down the existing value. Imagine you have a pie, and that pie represents all the value in the economy. If you suddenly cut that pie into 1,000,000 more slices, each slice, each unit of currency becomes worth less. The total size of the pie, the total value has not increased. You just have more pieces, and each piece is smaller. So, no, they are not creating value out of thin air. They are just diluting the existing value. Once you truly grasp that value cannot be created from nothing, the most important question you need to ask yourself becomes, how can I accumulate more units of value? That is the core of wealth building. It is not about chasing illusions, but about understanding where value comes from and how you can acquire more of it. Legitimately, this concept of viewing everything in units of value is a foundational principle I now apply to every business decision and every investment opportunity. Now, let us move on to the second absolutely crucial concept. And this is where many people hit a wall, leverage, and scale. For some, this wall might appear when they are trying to get past making $10,000. For many others, it is when they hit around $100,000 a year in their business or investments. And for the lucky few who push past that, they often get stuck at the $1 to $2 million mark annually. The key to pushing beyond these plateaus is understanding and utilizing leverage and scale to your advantage. It is about growing faster and more efficiently than others. There are essentially two main ways to think about this. Let us say you are capable of working 40 or 50 hours a week. That is your direct input, your personal capacity. But how do you multiply that impact without physically working more hours yourself? That is where leverage comes in. Let me give you a real-world example, and this might sound a bit harsh, but it is how businesses operate. Imagine I have $80. Instead of me spending 4 hours doing a task that might generate, say, $100, I could pay someone $20 an hour to do that same task for 4 hours, costing me the $80. But here is the critical difference. Their 4 hours of work guided by my strategy might generate $800 for me. For example, I could have them write some blog articles, which then drive traffic and sales to my business. I pay them $80, and those articles generate $800 in revenue. Now, I know what some of you are thinking. Nate, that sounds like you are underpaying them. They are creating so much value, and you are only giving them $20 an hour. And that is a valid point in a moral sense. But from a purely business and economic perspective, that is how the capitalist system works. Every business that hires someone does so with the intention of making a spread. They aim to generate more revenue from that employee's work than they pay the employee. If you are making $50,000 a year at your job, chances are your employer is making $100,000 or $200,000 a year off your work. That is the goal of a business, to create that spread. Now, I am not advocating for underpaying people, absolutely not. Always pay market rates, ensure fair compensation for the work done. The point is about understanding that this spread, this difference between the cost of labor and the value it generates, is how businesses scale. It is how you, as an individual, can also scale your efforts. So one aspect of leverage is outsourcing tasks to others who can perform them efficiently, allowing you to make a spread. But the other equally important aspect is saving your own time. In my example, by paying $80, I saved myself 4 hours of work. Now those 4 hours are freed up, and I can use them to focus on high-level tasks, strategizing, finding new opportunities, or replicating this leveraged process with other entities. This is how you accumulate wealth faster, by effectively multiplying your time and effort. A common pitfall I have observed, and one I have struggled with myself, is the inability to truly let go and allow others autonomy. Many people try to use leverage by hiring help but then micromanage every single step. This defeats the purpose. If you are constantly overseeing and directing, you are not actually saving time. You are just shifting your effort to truly scale. You need to empower people, give Give them the freedom to do their work effectively and trust them to deliver. It is a big lesson that many entrepreneurs, including some of my YouTube friends, find incredibly challenging, but it is absolutely essential if you want to reach higher levels of success. Okay, now that we have covered inputs and outputs and the power of leverage and scale, I want to talk about something that helps tie all this together. Especially when you, like me, do not always have endless hours to dedicate to managing every aspect of your finances. This is why I personally use Wealthfront, and I think it is a great tool for passive investing. What I really appreciate about Wealthfront is how it simplifies investing. It allows you to passively invest in the markets, which is a huge time. You do not have to spend hours trying to pick individual stocks or time the market. This passive approach also helps you with dollar cost averaging, investing consistently over time, which is a proven strategy to smooth out market volatility, instead of guessing which stocks to buy. Wealthfront diversifies your investments across various asset classes based on your risk tolerance. It does the heavy lifting for you beyond its user friendly interface. One feature I particularly like is their tax loss harvesting. This helps you reduce your tax burden by strategically selling investments at a loss to offset capital gains. For a really minimal fee, just 0.25% annually, and with an account minimum of only $500, you can start investing with them. If you look inside my individual investment account, you will see how easy it is to navigate. You can see your returns over time, your dividends, and even an estimate of your tax savings. You can view your entire portfolio at a glance. They also offer recommendations that you can adjust based on your risk tolerance, whether you want more aggressive or more conservative options, and you can customize the funds within your portfolio. Wealthfront has recently added hundreds of new investment options, giving you even more choices to build a portfolio that truly excites you. For example, you can get exposure to clean energy companies, socially responsible investments, healthcare, innovation and technology, even cannabis and cryptocurrency. Let us say you are interested in socially responsible companies. You can easily click through and find a variety of funds focused on that. Or perhaps clean energy is more your style. You can add those to your portfolio with a few clicks. And one of the most exciting recent additions is their crypto investment options. If you have heard a lot about cryptocurrencies but feel overwhelmed about getting started, Wealthfront makes it incredibly easy to gain exposure. You will see options like the Grayscale Ethereum Trust and the Grayscale Bitcoin Trust. Adding these to your diversified portfolio is straightforward, and you can even choose the weighting you want for them. The whole setup process takes just a few minutes. Wealthfront stands out because it offers a way to get exposure to Bitcoin and Ethereum as part of a diversified portfolio, complete with automatic rebalancing. It is a solution that integrates these newer assets into a more traditional, balanced approach. So, a big thank you to Wealthfront for sponsoring this part of the video. I will leave a link down below where you can get your first $5,000 managed for free. I use them myself, and I honestly think you might find them really helpful too. Alright, let us shift gears to the third crucial concept, and this one is vital for knowing when to act and when to hold back. It is about understanding which phase of the business and economic cycle you are in. There are typically four primary phases: the stealth phase, the awareness phase, the mania phase, and the blow-off phase. And truly understanding this cycle is critical. My rule of thumb is this: by the time something hits the front page of major news outlets like CNN Business, the New York Times, or the Wall Street Journal, it is usually already too late to get in at the ground floor. If it is not entirely too late, you are certainly not in the stealth phase, and likely not even in the awareness phase. You are most probably entering the mania phase.